Okay, guys, how we doing? Here it's Thursday the 16th, so it's a traditionals day. All right, so you guys saw the polling here. And first up was, well, your most popular choice is what I'm looking at. So I'm going to show this to you. I do think there's a good-looking trade. Now, I know you can't see that, right? So we're going to get there in a second. But I do think there is a low-risk, relatively low-risk play setting up right now. So we looked at this a couple of days ago. And my suggestion was that based on the way I'm reading this, that we have a completed impulse here. So if that's the case, that on the assumption that we haven't gone 3, 4, and that this is our 5, seems unlikely. Not that it's not possible, just seems unlikely. Well, if this is the 1, also unlikely would be that that's our 2 and that we're going to keep up here. So my assumption is that we are still in the process of correcting this completed impulse. Now, if you look at where we retrace to, and I think I drew this up the other week, where we had all of this prior resistance became the support here. So just looking at that symmetry, again, I know you can't see in here, but if you look at that, you know, you have to ask yourself, well, based on the depth of that retracement, it looks very consistent with what might be a 4. So you'd have to consider the alternate that this is the 3, we've done a 4, and now we're going up for the 5 of the 1 at this degree. So if this analysis is incorrect and the market is stronger here, then you might find yourself, we might be, well, this trade would long be stopped out. We'd be looking to put the 1 here still on the assumption that this impulse needs to be corrected. Well, needs, maybe the wrong word, right? Is likely to find that it will be corrected at some point here. And so obviously we'd be looking for something closer to a 50% retracement. So I'd have to be pulling this up here. Then we'd be looking for something in this range here to correct that. If this ends up being a 4 into a 5. I don't think that's the case. Otherwise, I wouldn't be suggesting the trade. Because I think if we having worked through all that subdivision multiple times here, I think we have a completed impulse, right? So far, as I suggested the other day, it looks like we have a very solid A wave going in. It would appear that the B is going in now, and we'd be playing this for the B to the C. Now, so you get the broader structure here of what I'm after. Let's put this back here. So I'm going to go from where am I, 4 hour. Let's go down to the 30-minute here and open this up and get a better look at it. Okay, so let's get this off of here. Oh, right here, I'm just going to build these one at a time here. So note here what I've got. I got a couple of things here. So I've just taken, rather than typically I'll have visible range over here. I mention it all the time. So you got to be careful about what that's showing you relative to to the visible range, right? So I'm just taking the fixed range, so it allows you to define this, right, on the assumption that you have this volume profile indicator and whatever package you have with TradingView. But this would be the fixed range, so we can draw it. So I'm just drawing from the swing high to the swing low, looking for any confluence here. So I'm looking for a couple of things. One, I'm looking for low volume nodes, and you can see here we get a very nice potential. It's just that. So I'm just wicking off the ridge of highs up here and noticing how that all fits in nicely with the golden zone. So resistance, resistance, resistance becomes the support. Support breaks it, resistance. All right, we're going to come back up and get resistance. So we have some structure here. We have low volume node here. So the market has not accepted that price, right? It's been rejected. So the premise of the trade here is that as we come into this little low volume node, we have both a technical setup as we're approaching the golden zone. We're approaching the upper parallel of this set of median lines, that we've got a relatively low risk entry here. So what we're trying to catch is the perfect tag here as we come up and approach the golden zone, looking for that reaction, right? We know there's likely to be software there that would set up a move. Pull this up here. So even if we just go after the first target here, so first algo target off of this is we know there's going to be software there, dominant swing high to low. There will be software that will kick in to sell there with this as its first target, second target, right? So now we're getting closer to the 50 here. So this is our potential, the potential plays for the C wave down here. So let me clear some of this up here. So I got it. This is actually kind of hard to get off. All right, there we go. All right, so let me zoom in here on this section coming down. So it's pretty much just, it's spot on as where we left it. So let me get this out of here and just open this up a little bit. Okay, so here you can see this pretty clearly, right? So we've got a 1, 2, it would appear we've got a 3, 4, right? So diagonal coming down here for the 5, and it's nicely technical, right? We went over this the other day. Oh shit, what I had, we had this one from the 3, right? So here's the, it's a tough call, right? So are they using the 2? All right, so here's the 50. We get golden zone, you go back 1, still good there. There's 2, the tick. Right, so it's always a little bit of, you're trying to, what'd they use? Did they use this? Did they use this? Right, here's 50 to the tick, front run on the target. It's hard to know, right? So we're trying to make our best guesstimate. If it's not to the tick precise, what'd they use? Right, so it could be either one of these, right? Either one of these are getting, you've got precision here on the entry. How beautiful that is. But front run could be. That's 2,800. The target was 5. That could be too much. It's hard to say, right? So I know I've got a move here. I've got a reaction off of this. So it could be this is a front run. Could be they used a lower pivot up here. That would be a little closer, 50. That looks a little more likely here if they used the 2. We're always just one, what'd they use? So this, as I recall, we had one other in here. Was it this one? Well, it didn't. Shit. You get the idea, right? So the idea being that I've got a 1, 2, I've got an A, B, C into a 3, A, B expanded flat into the 4, right down for the 5. So that gives me my A wave completing here. So A's done. It looks like I'm in a nice A, B, C, and I'm approaching. So the assumption is I'm putting in my B wave here after this A. So I'm trying to correct that. So obvious places we're going to look, right? So first I just drew it up here. So here we're coming up to the golden zone. I've got a nice set of median lines here. We had a little pause at the median line here. And now it looks like we're after that upper parallel. All right, so we look there. So how to trade it. Now, one other thing I'll just note here. So we've got this structure here. As we see coming into this initial pivot down before we started, now coming back into. So I got a lot of ingredients here. Now we look at the oscillators. Okay, we're mighty hot here. So we don't have, we have some fading volume, as you can see this. You got to be careful. This can change pretty dramatically here. But as we're going up, we're losing volume. I don't have a traditional Elliott oscillator divergence here. I'm very hot in the RSI, but you wouldn't really call it divergence. So you're going off, the indicators are not really lining up here. Now we're on a 30-minute here. I wouldn't go below that. So recognize that you don't have everything in play. You don't have that traditional Elliott oscillator. So as you look at this, if this is A, B, you got to think 1, 2. Are we done? So this is my point being that if this is 1, 2, and we're going up to 3, and we're going to have a little trace, and we're going to get the 5, well, we're going to be long out of this trade. The premise of this trade is that we have a very we have a very tight risk control, right? So we're trying to get it, if we come up and tag that, so let's call it 28.99, but essentially the trade that I would do here is, now personally, I would do it in options right now. So, interesting, we got a couple other choices now. So I'm assuming any of you guys that are interested here have seen the micro ES futures that are trading 1/10 of the size of the mini. Right, so we have this micro futures contract here. It's an option for you. So if you're not familiar, comfortable, or trained in using options, then the micros might be another choice. I mean, obviously, right? If you've got the resources to do it and you're comfortable with the risk, hell, trade the futures. Put a stop on it, but trade the futures. So but the key to it is that we have a very tight window here. So if this is going to break the 65, then we want to be out of it. So we're looking for a precision strike. So the assumption is we're going to come up right into the golden zone, and we're going to get that reaction. Now, if we get something like this and it pops up, you got to bail, right? This is absolutely about precision, right? So we're looking for something like this to come out of that. Now, the temptation with options is to overstay your welcome because you have that benefit of time. So you're not forced to make a decision there. Well, a function of how you structure the option trade here. So that potentially you could get yourself in margin trouble if you're not disciplined about getting out of it. So, but I guess what I'm trying to say is, as we come up here and we approach 2,900, the way I would do it, I would buy the 20. So as we're going up, we do have increase in volatility. So it's not ideal for premium buying. Remember, when you're buying, time is always working against you. From the second you're filled, time is working against you. So you got to be very conscious of that. So the only reason I would go after this with options, one, the backdrop and some of the macro issues that are at play here, and it's one tweet from Trump, and things can be very volatile. So I would do it in an option. I would buy the 2,900 put, right? So the only benefit you're getting is that as the market's moving up here, puts are going down in value a bit. It's inflated. All of it's inflated. The premium is inflated. So thus, if you're going to be a buyer here, you're buying an in-the-money put. Understand that, right? So if we're buying at the 2,900, we're buying at the money. So we get the maximum return. It's not dollar, but it'll be 50 cents on the dollar as it moves down. Then it'll start to increase as it goes deeper and deeper in the money. But the risk here has to be really disciplined. So if we break that 65, if you want to give it maximum exposure, you can say, if I get a candle that closes above the 65, so you don't just get a pump wick that takes you out, but a candle close above 65, you bail, right? You just take the loss. It will be modest, but you're going to take a loss, right? Just the fact that the premium will change, you'll have to buy it back. Pardon me. You'll want to close it, but you'll take a loss, right? So you will take the loss if we break that 65. So recognize that. So if we're trying to get this as a put, this is our target here. So you've got a pretty good size range here. Now, if you're very comfortable with option trading, what I would do as well is I'd look to sell some of the out of the money call spread to offset the cost. I just looked at the pricing. It's about $2,500 to buy an at the money put there. 25, 2,600, depending on where you're filled, and if this is going to keep going, it'll be in that range. Right? So the idea is not to risk the entire. I'm just going to use a round number. Let's call it 2,500. The idea is not to risk the entire 2,500. Max risk in an option you buy should always be 50% of its value. So if you see a drawdown on that value approaching 50%, you just bail. That's got to be habit. I know it's tempting, right, to think, oh, well, it could come back. Right? I've made that mistake, guys. Trust me. There's got to be an absolute contract with yourself. If it breaks this, or if I get to a 50% drawdown, I just take the loss. Right, so with that thinking here, that's how I would do it to get the maximum return on your dollar, and relatively. So we're talking about, let's call it $28.99. Your exit if we get up to $29.06. So 6-7 point range roughly here that you're looking at here in terms of allowing that kind of volatility swing there. But you really are looking for precision here. Now, if we put it in terms of the potential upside here, having defined where we know we're wrong and we're getting out, the potential upside here, if you start looking at this going to the 50, put us down here at 26.92. Right, so if you've got an in-the-money put here, a 2,900 put, and you're down here at 26, you've had a very successful trade. So that's the potential upside here. So if you look at, in theory, the risk-reward here, right, it's pretty dramatic, right? So huge potential upside if it turns there and we get a move down to the 50 with relatively modest risk, right? Not that it won't sting, it will. But, right, no risk, no reward. So that's how I would do it. Again, the other alternate is to just take the entry here. I wouldn't sit with a limit order, but I would, if you see a reaction at the golden zone, then you can go into one of the micro futures, reduce. Maybe you take multiple lots there so you have some potential exit strategy here. So you might take your initial, right, if you get the turn, big if we get the turn, initial profit target first algo target here, secondary at the second, where you'd be back at the 50, and now you'd be looking at the buy side from here. You might do the same kind of thing. So you might look then here, as the market's been coming down, now you're looking to buy at the calls, right? Do them at the money. So I was looking at June, that has about 30, what was it? 36 days till expiration, right? So you're buying an option that's going to decay quickly. Recognize that, right? So this is the reason you'd go there is because you're looking for this to happen soon. Now, typically, you would not want to be a buyer of options with, well, you wouldn't want to be a buyer with less than 30 days. So you're right on the edge of that, but you go out beyond that and it starts to get more and more expensive. And because you're looking for that precision here, there's no reason to go and say, oh, I'm going to wait to go to a 60-day option. One, it'll cost you much more because you're paying for that time. And we don't need it, right? This is either going to happen and turn or it's not, and we're out, one or the other. So that would be my thought there. All right, again, the other alternative being the micro futures. All right, so I'd alarm it. If it tags it and you get a little reaction there, I'd go right into that option or right into the futures. Okay, guys, back to you.